Let's get back to the market action with Ryan Lamont, co-founder and CEO at Neovision Wealth Management. So many issues to go through. Maybe let's just start with global markets and the fact that U.S. markets are so buoyant. You have all of those four majors reaching all-time record highs. You could say a similar thing about MSCI Asia Pacific as well. Happy days for equity investors, it would seem.
Absolutely. And as you said in your LinkedIn post a couple of days ago, Jerome Powell in the Federal Reserve has given everyone something to chew on, the bears and the bulls. But everything favors today more rises in the U.S. equities. It's favoring it. M2 monetary basis at the highs, everything at the highs. It seems positive. NVIDIA investing into Intel, more data centers, more AI adoption. So absolutely, everything is going up.
Yeah, what's going to go wrong?
What's going to go wrong, might go wrong, in my opinion, is AI adoption again. It's the strength and weakness. If you go back to year 2000, internet, we thought in year 2000, that's it. Everything is just fly and go to the moon. However, we discovered later on that actually integrating internet will take time. It actually took 10 to 15 years to come to the Internet of Things. So AI today, yes, we're using it on a daily basis, but is it really integrated? Has it really changed our lives? I don't think so. We're at least 5 to 7 years away from that.
And yet, anything that is tangentially exposed to artificial intelligence has been doing phenomenally well. So you're cautious of that?
Absolutely. Just like year 2000, everything was going up back then. Today, it's the same thing. AI is the future. I'm not denying that.
The difference back in 2000 is people were plowing money into non-profitable companies. The difference with the big, magnificent seven, or at least the major stocks, the outperforming ones, the top three, is they are extremely profitable, and you are seeing very strong revenue growth, 20, 30%, and other businesses would be very envious of that type of growth. So the growth profile is actually there, and so is the profitability.
100%. Cisco in year 2000 was the only routers manufacturer. It was very profitable as well, but still, it dropped. Microsoft was very profitable. From year 2000, it took 16 years for the Microsoft stock price to go back to par. Yes, absolutely. Profitability is very encouraging today. But is AI really integrated? Are we there yet? No, we're 5 years away.
For an investor, we speak to a lot of people who manage retail money, family office money, and everyone wants to be somehow exposed to the AI trade. If you're not in it, there must be a certain degree of FOMO. You won't be beating the benchmarks. You'll be underperforming the benchmarks for a very long time. So then how do you position the portfolio? How do you explain the underperformance?
Well, we've beat the benchmark without having exposure to these stocks. So our model portfolio has made 27% year to date without any U.S. exposure. Chinese stocks, as you know, we've bet on it quite early. Gold, Swiss stocks, dividend-paying stocks, some cherry-picked UK and European companies. We've done 27% year to date. Do you want to talk about the U.S.? Build-A-Bear company, its stock has beaten NVIDIA stock year to date, since 5 years actually. Domino's Pizza, look at the performance. So there are stocks that are beating AI stocks, but yes, should people invest into AI? Absolutely, hands down.
Yeah. Gold, ever since I've been speaking to you, at least for the better part of this year, you've been a gold bull. We are, 3,700 is where we are. What is your target? How far more? How much longer do you think this bull rally can be sustained for?
Our target is not a time stamp. It's actually all of these parameters that are pushing gold up that are making us continue to be bullish on gold. So it's a continuous trade.
What do you think could derail the price of gold from here? Because one thing that we've spoken about a lot is, geopolitical uncertainties. That has been, one catalyst for people to put money in, the opaqueness of the economic outlook in the U.S. But as things start to look up there, would you not perhaps see money withdrawn, the money that was put in, as a safe haven hedge? Would you not see some of that money come back out again because there's less conviction about, wanting to be positioned in some of these defensive trades?
So there are 5, 6 parameters that have pushed gold up. One of them is U.S. dollar dropping in value versus gold rather than gold going up in price. This is how we see it, the other way around. So one of these factors is China being the manufacturer and the U.S. being the consumer. Neither of these can beat the other. If they agree, yes, this would remove a big element of gold going up, because then China would go back to potentially buying treasuries and having US dollars as a reserve. So that's one element. People withdrawing, I doubt. People would just stop buying and just maintain. Potentially some of them might withdraw, but gold going back to 2,500 or below, that's very, very much unlikely.
Is there a target? Do you have a target?
Well, the first target is 4,000 before the end of the year.
Yeah. Okay. We probably might get there, given the extent of the performance. Ryan, always good to chat to you. Ryan Lamond, co-founder and CEO at Neovision Wealth Management.